Until today, Google had been a favorite of the so-called smart money on Wall Street, a buy on the dips favorite. Closely watched funds like Blue Ridge Capital and Brave Warrior Capital amassed sizable positions in the last year. Legendary value investor Bill Miller of Legg Mason Value Trust, that's the guy that beat the market 1 year at a time for 14 years. He's long praised Google. But a question, has anything fundamentally changed at Google? Well, joining us from New York is a guy long focused on Google's fundamentals. Morris Mark, president of Mark Asset Management, started 25 years ago with $10 million under management. Today, that's up to $1 billion. Google, one of his top 5 holdings. But Morris, he told me he dumped some shares this morning. Ye of little faith, time to give up on Google?
Sure. If you're asking me, Cory, the answer is definitely no. We sold.
So why'd you sell this morning?
We thought the stock was going to go down.
Okay, crystal ball, you're right. But you think maybe you should be stepping in? Why?
Okay, well, I'll just tell you what we did. We sold some of our stock this morning, and we neutralized the rest. And about 3:45, we ended that neutral position. So now we're once again heavily invested in Google.
So what is it about the company that has changed over time? You know, you and I were talking earlier today, and it's not the company that it used to be, but you still like a lot of the characteristics financially that this company's shown for quite a while.
Well, the financials are superb. You've got roughly $115 a share in cash. You've got free cash flow that roughly equals reported earnings. You have 29% revenue growth, and you have excellent growth prospects for its core business because it's a world franchise. And you've got a lot of new platforms they're developing to encourage user engagement. So in that context, there's a lot to like.
Well, Morris, we just put up a chart of that free cash flow per share. It's kind of an amazing number because most companies, when they show earnings per share, those earnings don't always get their way down to cash flow because there's so many capital expenditures and other garbage that shows up in the cash flow statement that the value of earnings doesn't always get to the company.
That's right. I think with some of the leading tech companies like Apple or Oracle or Google, these are really superb businesses with financial characteristics that really aren't appreciated by investors. They don't have a lot of capital spending because they expense almost everything. And what's left is earnings, and what's left is free cash flow, and it gives them a lot of financial power, a lot of flexibility.
Now, let's talk about that cash position. I put together a chart of the biggest companies in tech and their cash war chest. And Google, because they're not paying a dividend, in part, because they're not really buying back shares, has an amazing amount of cash when you look at competitors like Microsoft, competitors like Apple. Is that important for a company like Google?
Well, I know sometimes you can probably have too much, and I think their opinion, my guess, is that they're still in a growth phase. They want the flexibility of being able to use that cash on an opportunistic basis, though I do believe they should be paying a dividend. I absolutely do believe that.
So now you mentioned earlier about the earnings growth, and we had a chart briefly about net income growth. I want to take that chart again on net income growth because, you know, one of the things you can understand why people might be concerned that fast growth has slowed down is because net income growth has slowed down. You know, in 2010, 30.4%. That's down from 54.2% the previous year. That's not a good trend, is it?
No, it's definitely not. But, you know, these are big companies now. We're not assuming it's going to grow at 50%, and we've been in the stock since the time it went public. But we do believe that if you look at the numbers, you look at the revenue, you look at the growth of things being done online, you look at all the mechanisms the company is doing to engage users, that there's a heck of a lot of growth that people are not paying for at the current time. Now, whether that's 15% or 25%, I think a lot will depend on how good a job the new management does. But it's going to grow.
Now, technologically, really quickly, what's the one thing that you think is the best thing in Google's favor to resume that kind of great growth?
Well, I think it's two things. One, you have a CEO who, in some ways, at least on paper, he's got to prove himself, is very much like a Steve Jobs or the way Bill Gates was. People that are technologically driven, in the case of Steve Jobs and Bill Gates, people who turn out to be great businessmen as well. If you can put those two combinations together, you have an unbeatable combination. And to be fair to him, I do like some of the things he's done so far, the reorganization into key divisions, freeing those divisions to have room to maneuver, to create, to innovate, and then report to him so that he can, in effect, help them decide, probably say yes or no on key product decisions.
All right, Morris, Mark, really appreciate it. I know you've been following the stock for a long time. We're glad to have your insight because a lot of people want it. Thanks a lot.
You're welcome, Cory. Enjoy.